Welcome to It's the Economy. The government will announce the second half borrowing program, possibly this week itself, today or tomorrow. Here is the math. The government said in the budget it will borrow 14.82 trillion rupees through government securities in the full year. In the first half, the borrowing was 8 trillion rupees. So, obviously, the government will borrow 6.82 trillion rupees in the second half if it is sticking to the deficit. Now, this isn't large. The worry is there is very little appetite for long tenor bonds. In the first half, 35% of the borrowing was done via 30, 40 and 50-year bonds. The market is worried about this high percentage of long bonds in the second half because demand for long bonds in India and world over has been dwindling. To discuss more about bonds, interest rates, I have with me Arup Rakshit of HDFC Bank and Shailendra Jingan of ICICI Bank, both heads of treasury in their banks. Arup, Shailendra, good morning and thank you very much indeed for your time. Arup, first up, is there a fear of the borrowing number being more than 6.82 trillion?
Lata, honestly, good morning. We don't expect it to be actually more than 6.8 trillion. I think they will manage it. They have been very candid about it. The GST cut, even in spite of the GST cut, I don't think the borrowing program is going to go up. If they need later on, they will possibly cut a little bit of government expenditure if it has to come to that. But 6.8 trillion seems to be the number they have in mind, and I don't think they're likely to increase the number.
Yes, Dr. Somanathan has been almost Brahminical about this austerity program. But, you know, it's about a 1.5 trillion giveaway. So that's why I'm wondering. And at a time when tax earnings, collections have been much lower than anticipated in the first 5 months. Shailendra, a quick word on the total number. Will there be a fiscal slippage and therefore 7 trillion or something? But more importantly, what is the percentage of long bonds that you're penciling in?
So, Lata, we really don't anticipate, like Arup said, any kind of increase in the borrowing number. There might be a marginal slippage on the fiscal deficit side, but the government has enough buffers. One thing which markets are not really looking at is the fact that the small saving collections this year could be significantly larger. If need be, they can announce higher T-bills if there's a bit of a slippage. But the impact of GST on the current year is not that significant. You're right about income tax, collections being slower, but we know that, there are other buffers in the form of higher RBI dividend. So in that sense, I mean, there is absolutely, very little probability, I would say, of any kind of slippage.
Okay. Fair.
The absolute number. Now, coming to the, you have kind of brought up the point about the long bonds. And why the spreads have been rising and the yields have been rising on the long bond. And just to give a context, till about 5 years back, the government of India borrowing at the long end used to be about 20%. It went up to 35%. A lot of it happened because the domestic institutional investors, had very large flows. I mean, we know that, the non-par product of insurance companies started picking up. There was a very strong growth in, pension funds, provident fund AUMs, and they were all long end buyers. I think if you look at the last 2 years, there has been a very distinct shift in the profile of financial savings. I mean, for instance, last year we had 64 billion of inflows into equities, from DIIs. And this year, this number has already, by September, it has reached almost same level. And it is not just mutual funds we know who are getting these inflows, even let's say in insurance, most of the flows seem to be going to ULIPs. Somewhere the government is also incentivizing, for pension funds. I mean, the minimum allocation for equity used to be 15, it has gone up to 25. So their allocations are increasing. So, there's a shift. And that needs to be recognized. And because of that, I mean, there's a need to shift, the supply from the longer duration bonds to shorter duration bonds. Okay. Just one more point here. I mean, it's not just about, these institutional investors. I mean, if you look at, the bank's investment norms, which came from FY25 onwards, I mean, the HTM has become a real HTM. So, the appetite of banks to buy long end in HTM books is also coming down.
Yes.
So our sense is that, they shift about 4 or 5% from the long end and move it to the shorter end tenors. I mean, that's how, this will look like.
Okay. Arup, very quickly, would you want to add to this disappearance of buyers from the bond market that Shailendra has argued very well? And assuming the government, instead of 35%, brings down the 30-40-year bonds to even, say, 30% or 25%. That's a large fall. Will that really make any difference to the 10-year? Will that make any difference to the actual cost of capital for corporates?
See, what has happened is because of the 35% coming in that bucket, the demand from the banking industry has been a lot lower, which Sandeep did refer to.
Yeah.
And even if at a 10-year is around 26% and 15-year is around 14%. So if you really look at it, our expectation is that some amount of shifting will happen in the 5 to 7-year bucket, which can bring in a little bit of a demand. Today, it's the supply which is far outstripping the demand. So our expectation is it will be more in the 5 to 7-year bucket.
Okay.
See, the 3-year bucket is normally used for the switch, which they have been doing over during this year itself.
Yes.
So yes, 5 to 7-year, you will possibly see a little bit of a cooling of the yields, which really shot up to that 665 level on the 10-year benchmark in August. So that can have a little bit of a...
Okay, so that's all. They can issue more in the 5 and 7-year, you're saying, and less in the 30-40.
Yeah, about a 5 to 7% kind of a shift.
Okay. Well, the other big issue is what the Reserve Bank says. Now, what do you want to hear from the Reserve Bank, Shailendra? Cut or no cut, or what else? The bond market has really lost its verve altogether.
I think in terms of the policy, I mean, when we look at the inflation profile, Lata, for instance, our target for the current year average inflation is 2.4%. I mean, this is significantly lower than the 4% which RBI targets. Agreed, next year inflation will go up, but whichever way you slice or dice the inflation data, you let's say you exclude veggies and look at inflation. The inflation is definitely running below 4%. I mean, the ex-veggie CPI is at 3.7%. Post GST cuts, I mean, the core inflation number also will come down to 3%. So, from the inflation side, there is scope to cut rates. Now, coming to growth, I mean, we think that growth this year will be close to 7%. I mean, there's a negative effect, which is coming from the tariffs, but the GST cuts are coming. And I think there's a quirk in the deflator. So let's say you're getting a nominal GDP number of 8.5%. I mean, the deflators are likely to remain low, so the real GDP will be 7%. But I think what the policymakers need to look at is the continuous fall which has happened in the nominal GDP number. Just to give a context, in FY23, the nominal GDP growth was 14%. It came down to 12 in FY24. 9.7 in FY25, and this year, we expect it to be 8.5%. Now, this kind of nominal GDP growth has huge implications, not just for debt sustainability, but, for things like profit growth. I mean, we know what's happening in equity markets. I mean, the P's are high, but earnings are not there. I mean, so from all perspective, I think, RBI needs to move towards accommodation. Whether they cut in this policy or it's a dovish hold, I mean, I don't want to take a guess on that. But definitely, I think the bias, the talk will be more dovish. And, the policymakers should be looking at the nominal aggregates and the way they have been coming down.
Okay, 2.4 is the average. I thought it was closer to 2.8, but if...
Post GST cut, our average estimate has moved down to 2.4.
Fair enough. I think a poll is in order, and perhaps 2.4 is what I'm going to get. Arup, any thoughts on what you want from the Reserve Bank in addition to what Shailendra said?
No, I think, we are not expecting a rate cut in October for sure. I think it's more likely that they will see what action happens on the growth front post GST cut and then take a call in December on how it moves forward. Also, the tariff, some sanity on the tariff discussions may come through by December. So depending on how they look at the growth coming through or not in this business season, credit growth offtake, that can determine whether there will be a cut in December or not. Whether they go for an accommodative, October to me looks a little difficult to change any stance. I think they will just maintain the same stance, and because there's just too much geopolitical uncertainty which is playing out. So rather than do anything else, they will play it out in that manner. See, currently, if you see, the liquidity has dried up. I mean, it has. Yesterday was actually a deficit.
Okay.
So in that situation, to make announcements differently, they will play it out. And rupee is also not supporting the way it has moved. For them to take any new call at this juncture is my feeling of it.
But you don't expect them to make any pro-liquidity noises. I know yesterday was a deficit, but that's just because, advanced tax and rupee have...
It's a temporary one because the full CRR cut has to yet come back in the system. But if rupee starts trading that 88, 89.50 up to 89.50 kind of levels, which one expects it can go up, then obviously there may be some need to come into the market, which can then suck out the rupee liquidity also.
Okay. Shailendra, very quickly, do you expect them to say or do anything about liquidity? And, I have another separate question, but very quickly on liquidity.
So I think liquidity, like you rightly said, I think it's more driven by, currently by GST outflows and advanced tax outflows, which were larger this time because, the personal income tax filing date also got delayed. So the system has come in deficit, but the core liquidity is still at a very, huge surplus of 5 trillion. So I think in the near term, there is absolutely no worry on liquidity, or there's nothing which is required to be done on liquidity. So, and this, like Roop said, the CRR cuts are playing out. So I think they'll wait for that. Maybe at some stage later, they might have to, do OMOs. Our sense is that, they could be OMOs or bilateral swaps, which might come. But that will be a last quarter story.
I was just waiting for the word OMO because I think that's what the bond market will really be exhilarated. I don't see how they can introduce the word I will buy bonds from the market, in this policy itself, but that will be music to everyone's ears. Very quickly, Arup, what I couldn't concentrate on, state borrowings. The second half state borrowings can be very high because they did only, I think, 6 trillion in the first half. You think that can just spoil the play for corporates who are wanting to borrow from the bond market?
Yes, state borrowings are likely to slip, give a little bit of a slippage out there because it can be really high. And we had seen the gap increasing up to almost 100 basis, though now it has come down to about a 50 basis. But yes, that is something which can play out in the second half.
And
we expect states to borrow a little more.
And that can spoil the game for NBFCs and others who are tapping the bond market?
I don't think that will have too much of an impact for the NBFCs and all, but let's see how it plays out. Because yes, NBFCs have tapped the bond market quite well in this quarter.
Okay.
Effectively, see, the credit growth offtake has still not really picked up in that sense. It's still in the around that 10 to 10.5%, 11%. So if there will be opportunity for even the NBFCs to hit the market and get some. Whether the price may be a little higher than what they would have expected because of this, the state loans also being there. But otherwise, I think liquidity would be there for them to get the bond.
Yep, but who is to say if there is a cut on October 1st, then perhaps borrowing from banks also will become attractive. Let's wait and see.
It's unlikely that we will. I don't expect the cut on October 1st.
You're not expecting on October 1st. Arup?
No, I'm not expecting a cut on October 1st.
Okay. Well, we have the Citizens MPC, CNBC TV, Citizens MPC meeting tomorrow. Let's see how the vote goes over there. Thank you very much, Arup and Shailendra, for preparing us for the borrowing program and for the policy ahead. We have to wrap up on Bazaar. On that note, Chatbusters coming up.